Hello everyone, Assalamu alaikum. This is Akhtar Hussain. My student ID is 145. Our presentation topic is guidelines on risk-based capital adequacy. I will discuss now on balance sheet items and off balance sheet items. Here on balance sheet items, banks will include items using their accounting balance sheet for the purpose of the leverage ratio. In addition, the exposure measure will include the following treatment for securities financing transaction and derivatives. Repurchase agreement and securities financing. Securities financing transactions are a form of secured funding and therefore an important source of balance sheet leverage that will include in the leverage ratio. Therefore, banks should calculate securities financing transaction for the purpose of leverage ratio by applying the accounting measure of exposure and without netting various long and short positions with the same counterparty. Next, balance sheet items. On balance sheet items is derivatives. Derivatives create two types of exposures, and on balance sheet present value reflecting the fair of the contract, often zero at the outset but subsequently positive or negative depending on the performance of the contract, and a notional economic exposure representing the underlying economic interest of the current contract. Bank will calculate derivatives exposure including where a bank sells protection using a credit derivative for the purpose of leverage ratio by applying the accounting measure of exposure positive mark to the mark value plus an add-on for potential future exposure calculated according to the current exposure method without netting the mark to market values and potential future exposures regarding long and short positions with the same counterparty. Here balance sheet items. Here off balance sheet items. There are four types of off balance sheet items. Full risks and medium risks, medium low risks and low risks. Here full risks 100% credit conversion factor. Direct credit substitutes including general guarantees of indebtedness, acceptance, endorsements on bills not bearing the name of another credit institutions, transactions with records irrevocable standby letters of credit having the characters of credit substitute. Derivatives, forward asset purchase, forward deposit placed, the unpaid portion of partly paid shares and securities. Other items also carry full risks. And next stage is medium risks that include 50% credit conversion factor. First of all, transaction related contingents not having the character of direct credit substitute including warranties and indemnities. Next, guarantees, and third, irrevocable standby letter of credit. Documentary credits issued and confirmed, not issuance facilities, and revolving underwriting facilities also include in medium risks. Next, medium low risks that carries 20% credit conversion factors include documentary credits in which underlying shipments act as collateral and other self-liquidating transactions, undrawn credit facilities with an original maturity of up to and including 1 year which may not be cancelled unconditionally at any time without notice that do not effectively provide for automatic cancellation due to deterioration in a broad creditworthiness. And the last stage is low risks that carry 0% credit conversion factor, including undrawn credit facilities such as agreements to lend, purchase securities, provide guarantees, or acceptance facilities, which may be cancelled unconditionally at any time without notice, or that to effectively provide for automatic cancellation due to deterioration in a borrower's creditworthiness. Retail credit lines may be considered as unconditionally cancelable if the terms permit the credit institutions to cancel them to fully extent allowable under consumer protection and related legislation. Endorsement of bills which have previously been accepted by a banks and other items also carrying low risks. That's all about my topic. Thank you, everyone.
Assalamualaikum everyone, this is Farsan Akhtar Nila. My student ID is 147 and I am a student of Department of Banking and Insurance. In today's video, I'm going to talk about the leverage ratio. So we need to know what is leverage ratio and why we use leverage ratio. So here in the screen, we can see that in order to avoid building up excessive on and off balance sheet leverage in the banking system, a simple, transparent, non-risk based leverage ratio has been introduced. The leverage ratio is calibrated to act as a credible supplementary measure to the risk based capital requirements. The leverage ratio is intended to achieve the following objectives. Here we can see that there are two objectives. The first one is constrain the build-up of leverage in the banking sector, which can damage the broader financial and the economy. And the second one is reinforce the risk-based requirements with an easy to understand and a non-risk-based measure. So moving to the next slide. Here we can see the definition and the calculation of leverage ratio. A minimum tier 1 leverage ratio of 3% is being prescribed both at solo and consolidated level. The bank will maintain leverage ratio on quarterly basis. The calculation at the end of each calendar quarter will be submitted to Bangladesh Bank, showing the average of the month in leverage ratios based on the following definition of capital and total exposures. So here in the screen we can see the formula, and the formula is the leverage ratio equal tier 1 capital after related deductions and divided by total exposures after related deductions. So that's all from my side. The next topic will be discussed by my next groupmate. I hope this video is very much thoughtful and helpful. Thank you.
My name is Abdul Hussain Fahim and my student ID is 146. Today I will move forward today's topics named as capital measure and exposure measure. First I will go through capital measure. Capital measure. So we have to know that the tier 1. What is tier 1? Tier 1 capital is the primary funding source of the bank and consists of shareholders equity and retained earnings, paid up capital and general reserve. Then we have to know that the what is capital measure. The capital measure for the leverage ratio is the tier 1 capital of the risk based capital framework as defined in the Basel III framework. So we can say that capital measure for leverage ratio at the particular point in there is the applicable tier 1 capital measure at the time under the risk based framework. So we have to say that the capital measure are construct for two main purpose. First of all, to measure wealth or the market value of share or asset, to analyze the role of capital in production, that is capital measure. Then we have to go exposure measure. Exposure measure, first of all we have to know what is exposure. Exposure is a maximum potential loss a lender may incur if the borrower defaults. It is a risk measurement technique to assess the position of the lender and the characteristics of the borrower and the possibility of the loss. So we have to say that the loss exposure includes both an balance sheet exposure and off balance sheet item, or we have to say that the exposure measure of the leverage ratio will be the sum of on balance sheet exposures and their derivatives exposure, SFT exposures and OBS item. Thank you everyone. That's my part.
Assalamualaikum everyone. This is Abdullah Mamun, studied at University of Rajshahi Banking and Insurance Department. The last three digits of my student ID is 154. Today I will discuss about my selected topic, general instructions on capital adequacy framework. So let's discuss about in details. General instructions on capital adequacy framework. At first, we have to know that what is capital adequacy. Capital adequacy refers to the minimum amount of capital a bank or financial institution must maintain to absorb losses and continue functioning during times of financial distress. Banks provide loan to customers, but sometimes they provide loan bad customer. So they need to keep extra reserve involved against the bank loan, which is provide the bad customers. Next, the aim of general instructions on capital adequacy framework. The aim of capital adequacy framework identify the optimal balance of financial institutions, asset and liabilities and risk. That is very important for bank and customers, which is save money in the bank. Next, how to measure capital to risk weight asset ratio, that also called CRAR. CRAR, that's mean capital to risk weight asset ratio. Capital to risk weight asset ratio is an indicator of how well a bank can meet its obligations. The ratio compares capital and risk weight asset. It is used to protect depositors and promote the stability of financial system. Next, how to calculate capital to risk weight asset ratio. Capital to risk weight asset ratio or CRAR is calculated by taking eligible regulatory capital to numerator and the total risk weighted asset as denominator. The formula of CRAR, that means capital to risk weight asset ratio equal total eligible capital divided by the sum of credit risk weight asset plus market risk weighted asset and operational risk weighted asset. The total eligible capital is the amount of total capital of a bank for a bank. For example, suppose bank ABC has 10 million in tier 1 capital and 5 million in tier 2 capital. Two types of capital are measured. Tier 1 capital is core funds on hand to manage losses so that a bank can continue operation, and second, tier 2 capital, that is a secondary supply of fund available from the asset a bank closed down. So it has loans that have been weighted and calculated as 15 million. The capital adequacy ratio of bank ABC is 30%. So 110 million plus 5 million divided by 50 million. Therefore, this bank has a higher adequacy ratio and it considerably safer because the higher rate of capital adequacy ratio. Next, the scope of application. The Basel Committee provide a rate so that commercial bank keep in hand 8% of his reserve for against the bad loan. These guidelines apply to the all scheduled bank on solo basis and consolidated basis. Solo basis refers to the all positions of a bank and its local and overseas branches. Next, consolidated basis. Consolidated basis refers to all position of a bank and its subsidiary company who is engaged in financial activities. So it is all about my side. So thank you very much, everyone.
Hello, this is Proshenjit Kormukar. My bearing ID is 2011037055. So my following mate have discussed about CRAR, which is the abbreviations of capital to risk with it asset ratio. Now I will discuss further about this topic. There will be start with scope of application of that CRAR means capital to risk weighted asset ratio. It is report requirement. Now I'll move forward. Report requirement to protect the depositors and promote stability of financial system. Report requirement is needed. CRAR reporting. All banks are required. Now I will move forward with my next topic. The name of the topic is report requirement. To protect the depositors and promote stability of financial system, report requirement is needed. CRAR reporting. All banks are required to submit risk-based capital adequacy, which is RBCA, to a specific format prescribed by DOC, which is the abbreviations of Department of Offsite Supervisions. And the next part is ICAP reporting. ICAP reporting. Each bank must submit its ICAP report to Bank Supervisions and Policy Department BRPD of Bangladesh Bank, both in hard and soft copies, within May 31 every year, based on its latest audited financial report. The ICAAP reporting must be approved by the Board of the Director of the Government and submit to the Bangladesh Bank. The next topic is penalty for non-compliance of this requirement. The very first penalty will be Bangladesh Bank can impose various business restrictions, penalty and punishment as per section 13(7) of the Bangladesh of Bank Company Act 1991. On the next penalty can be if any employee willingly submit false document about the CRAR document, then that will be considered as a punishable offense. The third punishment will be Bangladesh Bank can impose penalty as per section 190(7) of Bangladesh Company Act if a bank fails to submit its risk-based capital adequacy report within stipulated time without satisfactory reason. These are the penalty can be imposed on financial institute and other banks if they are not complied. So that thank you. That's all.
Assalamu alaikum. This is Jahid Hassan. My student ID is 149. Today I will discuss about measurement of risk-weighted assets. At first, you have to know what is credit risk. Credit risk is the potential that fails to meet obligation in accordance with agreed terms. My next topic is methodology. The methodology means the capital requirement for credit risk is based on the risk assessment made by external credit assessment institution recognized by Bangladesh Bank for capital adequacy purpose. Banks are required to assign a risk weighted to all their on balance sheet and off balance sheet exposure. Risk weight are based on external credit rating, which with the Bangladesh Bank rating grade or a fixed weighted that is specific by Bangladesh Bank. Bangladesh Bank also has decided that bank may use the credit rating of the following international credit rating agency for the purpose of risk weighted their exposure at abroad. At first, the first topic is Fitch, Moody, and Standard and Poor's. Now you have to know external credit rating. Bangladesh Bank has recognized 8 credit rating agency of Bangladesh Bank: Credit Rating Information and Service Limited, National Credit Rating, Emerging Credit Rating Ltd, and Argus Credit Rating Service Limited, Alpha Credit Rating Limited, etc. Now my last topic is mapping of ECAI's rating grade. Within a corporate group, cannot be used risk weighted other entities within the same group. Each entity within the same corporation group needs to get rating individually. Number one, short term assessment, multiple assessment, easier assessment. That's all my part. Thank you everyone.
So our group member already discussed.
Assalamu alaikum. I'm Mohammad Kamri Hassan. I'm completing my bachelor degree from Rajshahi University under the Department of Banking and Insurance. My student ID is 18108371145. Today we will discuss about the measurement of risk-weighted asset, credit risk. Let's start. Credit risk means the potential that a bank borrower or counterparty fails to meet its obligation in accordance with agreed term. Bangladesh Bank has also decided that banks may use the rating of the following international credit rating agency for the purpose of risk weighting their exposures at abroad. Fitch, Moody, Standard and Poor. Methodology. The capital requirement for credit risk is based on the risk assessment made by external credit assessment institution organized by Bangladesh Bank for capital adequacy purpose. Banks are required to assign a risk weight to all their on-balance sheet and off-balance sheet exposure. Risk weights are based on external credit rating, which is mapped with the Bangladesh Bank rating grade or fixed weight that is specified by Bangladesh Bank. Collateral for credit risk mitigation. Where a transaction is secured by eligible financial collateral and meets the eligibility criteria and minimum requirement, banks are allowed to reduce their credit exposure or potential credit exposure to cover exposure under that particular transaction by taking into account the risk mitigating effect of the collateral for the calculation of capital charge. Calculation of capital charge. Where transactions secured by eligible collaterals, a bank need to first calculate the net exposure amount by taking into account the effect of collateral. The net exposure amount is then weighted according to risk weight of the counterparty to obtain the risk weighted asset amount for the collateralized transaction. On balance sheet netting. On balance sheet netting may be allowed where a bank has a well founded legal basis for concluding that the netting or offsetting agreement is enforceable in its relevant jurisdiction, regardless of whether the counterparty is insolvent or bankrupt, is able at any time to determine those assets and liability with the same counterparty that are subject to the netting agreement, monitors and control its role of risks, and monitor and controls the relevant exposures on a net basis. It may use the net exposures of loans and deposit at the basis for its capital adequacy calculation. Guarantee for credit risk and mitigations. To reduce credit risk transaction by the secured by guarantees, where guarantees are direct, explicit, irrevocable, and unconditional, bank may consider such credit protection in calculating capital requirement through a substitution approach. Only guarantees issued by or protection provided by entities with a lower risk weight than the counterparty will lead to reduced capital charge since the protected portion of the counterparty exposure is assigned the risk weight of the guarantor or protector provider, whereas the uncovered portion retains the risk weight of the underlying counterparty. Thanks, everyone.
The summaries of con- constituents of capital minimum requirements, and now I discuss the another sections of this chapter. So first of all, we see that the capital conservation buffer. So banks are required to maintain a capital conservation buffer of 25%, comprises of common equity tier 1 capital above the regulatory minimum capital requirement of 10%. The bank should not distribute capital in case capital level falls within this range. Then we see regulatory adjustment and deductions. In order to arrive at the eligible regulatory capital for the purpose of calculating CRAR, banks are required to make the following deductions from CFT1 or capital. Um, there are some qualifications. For example, number one, shortfall in provisions against entries and investment. So number two, the goodwill and all other intangible assets, and then deferred tax asset, and then defined benefits pension fund assets, and then gain or sale related to securitizations transaction, and then investment in own shares, and finally other one investment in the capital of banking, financing and insurance entities. This section is two categories, such as number one, the reciprocal cross-holdings in the capital of banking, financing and insurance entities. Reciprocal cross-holding of capital that are designed to artificially inflate the capital positions of banks will be deducted in full. Entity has also invested in any types of banks capital items. So number B, corresponding deduction approach. The another corresponding deduction approach, banks will deduct investments in the capital of other banks, the financial institutions and insurance entities from the respective tier of their own capital. I hope if you see uh, or listening this video, it will be benefited for you, and that's all for me. Thank you for listening.
Hello everyone, this is Mohammad Kausar Hussain. My ID number 153. I'm a member of Group 5. In this video, I will discuss about component of capital and minimum requirement. Component of capital. There are two components of capital, Tier 1 capital, Tier 2 capital. Tier 1 capital is a term used in banking and finance to refer to the core capital of a bank and financial institution. It represents the highest quality capital within a bank's capital structure and serves as a measure of the institution's financial strength and ability to absorb losses. Tier 1 capital is divided into two components: common equity Tier 1 capital, additional Tier 1 capital. Common equity Tier 1 capital. Common equity Tier 1 capital is the highest quality capital within Tier 1. It primarily consists of common equity such as ordinary shares or common stock issued by the banks. Common equity Tier 1 capital is considered the most loss-absorbing form of capital and provides permanent and stable capital base for the institution. It includes the bank's retained earnings and common equity issuance. Additional Tier 1 capital. Additional Tier 1 capital is the second component of Tier 1 capital. It comprises subordinate debt instruments with equity like features. These instruments can absorb losses and provide financial support to the bank during times of stress. Tier 2 capital. Tier 2 capital is a component of a bank's capital structure representing a secondary layer of capital that serves as a supplement to Tier 1 capital. It is a measure of a bank's financial strength and ability to absorb losses. Tier 2 capital is considered less secure and less loss absorbing than Tier 1 capital. Limits, minima, and maximum. Common equity Tier 1 of at least 4.5% of the total risk weighted average. Tier 1 capital will be at least 6% of the total risk weighted average. Minimum CRAR of 10% of the total risk weighted average. Additional Tier 1 capital can be admitted maximum up to 1.5% of the total risk weighted average, or 33.33% of common equity Tier 1 capital, whichever is higher. Tier 2 capital can be admitted maximum up to 4% of the total risk-weighted average, or 88.89% of common equity Tier 1 capital, whichever is greater. In addition to minimum CRAR capital conservation buffer of 2.5% of the total risk-weighted average is being introduced, which will be maintained in the form of common equity Tier 1 capital. That's all about for me. Thank you.
Hello everyone, this is Mahmoud Rezwanul Haq. My ID nong is 20108371144. I am pursuing a 4-year BBA program in University of Rajshahi and currently enrolled in 3rd year 2nd semester in Department of Banking and Insurance. Today I am going to talk about Basel III. Before initiating the discussion, we need to know what Basel is. What is Basel and how BCBS was created? Basel is a beautiful city situated in Switzerland. In this city, the headquarters of BIS is located. BIS was established in 1930 and it is one of the oldest financial organizations. In 1974, governor of Central Bank of 10 countries get together and formed a committee called Basel Committee for Banking Supervision, or BCBS. They started with basic guidelines how to mitigate the risk and avoid risk under their local jurisdiction that has expanded, and now there are a good number of member nations in BCBS now. The name and number of member nations and latest publications are available in www.bis.org. The BCBS committee offers a platform for ongoing collaboration for the member nations for banking supervisory affairs. An overview of Basel III. To strengthen global capital and liquidity rules with the goal of promoting a more resilient banking sector, the BCBS issued Basel III, a global regulatory framework for more resilient banks and banking systems, in December 2010. The objective of the reforms was to improve the banking sector's ability to absorb shocks arising from financial and economic stress, thus reducing the risk of spillover from the financial sector to the real economy. Through its reform package, BCBS also aims to improve risk management and governance as well as strengthen banks' transparency and disclosures. Strengthening the capital framework. The Basel Committee raised the resilience of the banking sector by strengthening the regulatory capital framework, building on its 3 pillars. Pillar 1 addresses capital and liquidity adequacy and provides minimum requirement. Pillar 2 outlines supervisory, monitoring and review standards. Pillar 3 promotes market discipline through prescribed market disclosures. The reforms raise both the quality and quantity of the regulatory capital base and enhance the risk coverage of the capital framework. Enhancing risk coverage. This is well known that credit risk arises out of counterparty default, but if the credit worthiness of a counterparty deteriorates, an additional capital charge is required as per Basel III to handle credit value adjustment risk. The guidelines on counterparty credit risk management with regard to collateral, margin period of risk, and central counterparties and counterparty credit risk management requirements have been strengthened. Supplementing the risk-based capital requirement with a leverage ratio. Basel III's leverage ratio is defined as the capital measure divided by exposure measure and is expressed as a percentage. The capital measure is currently defined as Tier 1 capital. Tier 1 capital leverage ratio measures banks' core capital relative to its total assets. This ratio is used by regulators to ensure the capital and liquidity adequacy in banks. A ratio above 5% is deemed to be an indicator of strong financial footing for a bank. This ends up my presentation. Thanks for watching.
Hello everyone, this is MD Kamrul Hassan. My previous speaker MD Rezan Holok has talked about the background of Basel and BCBS formation. He also gave an overview of Basel III and talked up to para 1.3 of Bangladesh Bank Guideline on Risk-Based Capital Adequacy. In my discussion, I shall cover from para 1.4 to para 1.7 of the same guideline. Introducing a global liquidity standard. Strong capital requirements are necessary for a stable bank sector. A strong liquidity base reinforced through robust